Okay, good morning, everyone, and welcome to the 8th Annual Laurentian Bank Securities Institutional Investor Conference. My name is Nick Agostino, Head of Research and the Diversified Technology Analyst here at Laurentian Bank. Also assisting me today is my associate, Solomon Rana, who will be helping me in the background to moderate today's fireside discussion. Before we begin, some housekeeping items. Just please ensure your microphone is on mute and your camera is turned off during the presentation. Also, please ensure your name appears on the screen so we can properly address any questions you may have. Also, I will pause or certainly take questions during the course of today's chat. So if you do have a question, feel free to use either the chat or just raise your hand, use the raise your hand feature, and we'll call you out to ask your question. And just a reminder that once you've asked your question, also remember to lower your hand just so that we know we've ticked off that box. And if you experience any technical issues during this presentation, please communicate on the chat and we'll try to address it as quickly as possible. Finally, we've also put together a guide for today's discussion, which you can access through the little CTS button on the bottom right side of your screen. So feel free to do so on that front. And then having said all that, we'll get started. So joining us today, we've got Shaun Maine joining us all the way from the UK for this fireside chat. So Shaun, welcome.
Thanks, Nick.
And we'll get right into it with the first question, just looking at industry trends. What signs is Converge seeing as it pertains to the expected rebound in IT spending in 2021, both on the hardware and the software side? And how is Converge positioned to capitalize on that expected rebound?
Yeah, so last year, even though we had fabulous numbers, we're the fastest growing IT service provider in North America, so we're not a fair gauge, but Gartner and Forrester talk about minus 3.3% IT spending worldwide. And yet this year, they're looking at a growth of 8.5% in software and 7% in hardware. And particularly Q1 last year, you actually saw people pull in spend pre-COVID. Q2 and Q3, I think, were most impacted across the industry. So the year-on-year numbers in Q2 and Q3, I think, will be significant across the industry.
Okay. And then maybe just talk about what secular trends you guys are seeing from the industry as a whole that you think is going to support, the industry growth that you talk about, and certainly the growth expectations that Converge has. I know that I think you typically guide to somewhere around 10% organic growth. So what secular trends are supporting that?
So the work from anywhere model really increased the need for a different security model. When people were working in an office, the way that you did security was you logged into your email and then you had a two-factor authentication would be done. And then you'd have this access control list to say, here's what you can access. And then you were a trusted user. When you log in from home, you go into a no trust environment where you have to validate yourself each and every time. All the data center infrastructure really needs to apply a new security model. Hence our Trust Builder platform. Why we've added it to all of our managed services is because you have a whole new way of verifying the people, the counterparties that you have. So that was something we saw a tailwind in last year and continues this year. But really it's the large services projects where you just really could, now 75% of our projects were remote anyways, but getting on some of these large analytics projects where you need to be on premise, you just couldn't do that last year. So that's another trend I think you're really going to see on the large services projects, the ability to go face-to-face, especially in the US as the vaccines are rolled out, as they are in the UK here as well, that you're really going to see an impact there. And then the stimulus in the States is a little bit silly, right? So there's a very positive growth environment, particularly around Q2 and Q3, but the move to work from anywhere, the trust model around that and services on site would think I'd be the biggest drivers I can see.
Okay. And then just looking at OEMs and vendors, they're obviously for their own margins looking to bypass resellers and directly distributing products and services to end customers whenever they can. Are you seeing any of that? And more importantly, if that continues to be a long-term trend, do you see that as being a threat to the business model you guys are putting together?
So it isn't a threat to us. It's a threat for people selling into the Fortune 500 because our OEMs, they know how to sell into large enterprise. They really don't know, and across the industry does not know how to sell into mid-market. And therefore, in fact, they're encouraging and looking for people that can sell into the mid-market. There is a different sales motion in the mid-market. In large enterprise, the reps are older and they're farming one account. In mid-market, they're 10 years younger and they're hunting 5 to 10 accounts. So there's just a different makeup. The way you approach things, mid-market customers will come to you, large enterprise wouldn't. So there's a completely different sales motion, and our OEMs are very good at selling directly to large enterprise, and in the mid-market, they're not. And you see the trend of actually moving away from support for direct sales, like IBM's completely moved away from a direct sales motion into the mid-market and are relying entirely on partners. So, but across the industry, you'll see all the vendor partners, they don't do a good job of mid-market sales, and that's where really we address a key need for those vendor partners, and I don't see that changing.
Okay. And then looking at your IBM partnership, I believe in 2020, you were the only one to experience growth or positive growth for that matter. And I believe it was up a nice 23% organically. So
Correct.
certainly congrats on that.
Thank you.
Can you maybe talk about how 2021 has started out with that particular relationship so that we can get a sense, was 2020 an aberration or was that more of a sign of good things to come?
So I think, and it was against their top partners. Yes, we're the only one to grow, and we grow significantly. And really, it's around IBM software, particularly Red Hat's products like OpenShift and Ansible around the Kubernetes and management side, but also Watson and analytics and QRadar and security. And I definitely see that not just so. Remember, we're the fastest growing, and we had, there was some headwinds last year. The tailwinds this year means I would expect a much higher growth rate from Converge around this. Remember also that IBM split out its two organizations. We were actually competing with their services organization. And as they split out, they're going to be relying more and more on the channel. And we are so well positioned to take advantage of that, especially in the second half of the year. A lot of these implementations are happening on July 1st. So I would expect in the second half of the year, us to have significantly higher growth rates than that around our IBM software and Red Hat.
It's good news. So switching gears to just talk about products and services and specifically managed services, certainly a higher margin piece of business, typically with a nice recurring revenue stream attached to it.
Yeah.
I think you've spoken in the past that you plan to take your managed services gross margins from the 40% level to the 50% level during the course of 2021. Can you maybe talk to, do you feel you're, as we sit here in the month of April, on point, and maybe just give us some more insight as to how you're executing on that plan?
Great. So yeah, right now, as of Q4, we had 56 million of annualized recurring revenue around our managed services. By the end of 2021, we plan to grow that to 100 million and move, as you said, our gross profit from 40% up to 50%. A lot of that has to do with scale and in the way we provide our services. So there's the base hosting part, but then there's the service desk, managed network, managed security, managed end user. And a lot of these, when you standardize the offerings, when you, especially on first call, move them into the right cost base around that, there's just scale. So as we go through that, you will definitely see those efficiencies happen as we grow our managed services. It's a key investment area. We've talked about our I-Series hosting, which is the AS400 and mini IBM platform that we are hosting applications like Infor, an ERP system, but putting the Google and the applications that use that data onto Google. The partnership with Infor and Google is a great one for first hosting, but then adding the managed services around service desk, which is like first call, managed network, managed security, managed end user. So this is a key growth area for the company and organically grown, and our highest margin area.
And sticking on that area of the conversation, because you mentioned obviously your private cloud ARR going from 56 million to 100 million this year, your managed services going from 70 to 100 million. And you said it's an area of investment. You did say organic. I'm also wondering, is there M&A involved in reaching some of those targets? In other words, can we foreshadow where some of that investment dollars from an M&A perspective are going to be spent this year?
So around capabilities, yes, I think that is fair to say. They tend to be niche, so I wouldn't be getting the customer revenue like that. So we just bought Dasher, fantastic company, really specialized around HP's skill sets like Aruba, no recurring revenue. So great opportunity for us to cross-sell managed services and cloud services into their customer base. But around capabilities to get that scale, yeah, I think some tuck-in acquisitions. We did some tuck-in acquisitions around capabilities like Vivo, around the trust platform. I think that's a likely candidate around the managed services to achieve those 50% gross profit targets.
Okay. And then you also mentioned the iSeries IBM platform earlier. Maybe just bring us up to date in terms of, I think in the past you spoke about a fairly sizable funnel of opportunities. Maybe give us an update as to what the size of that funnel is. Has it been growing? And then which opportunities you've been tackling, and how you basically figure out which opportunity you're going to take off the top first in terms of which offers the best benefits early on.
So yeah, there's an install base of 1,600 for Infor on iSeries in North America. We're targeting a couple hundred of those customers would be kind of a minimum target over a 2 to 3 year time frame. The one thing I'll caution is the onboarding time frame for larger customers can be 6 to 9 months. So we onboarded our first one in Q3 last year. We continue to onboard more customers, but there is a delay from engagement of these customers to seeing the recurring revenue. You see the services engagement around moving that platform, but those larger customers, it is a significant effort to translate them into this new environment. So there is a lag time before you see that recurring revenue jump.
Okay. And then just talk about products in general. Obviously, there's lots of talk around a COVID passport. Knowing that you have your Converge trust platform, and certainly that the acquisition you did recently to enhance that specific platform, where do you are you seeing any? Is it at this stage just a lot of government talk around creating that COVID passport, or are you seeing opportunities here in North America, over there in Europe, where governments are going to enact it?
It's not just governments. So the Golden State Warriors use an application that we developed, use our analytics practice as well, to allow spectators into games. So great way of saying, and it wasn't just the fact that if you have a vaccination card and a stamp, well, that works for a vaccine. It doesn't work for your last test. So what our application will do is, if you had a negative test and subsequently had a positive test, it would revoke the last one. So it's a live system to go in and say, what's your current status? Not the fact that I might have had a negative test in the past, let me into this basketball game. It's, what's my current status, and am I vaccinated? To do that in a non-reputable way is really important. We also have a lot of other clinics and governments that are going down this path. There has been some mixed reception in certain marketplaces, the UK being one, around, is it fair to allow, because there was a lot of tests of saying you need a passport to get a vaccine passport to get into a pub. There was some resistance locally. I think travel, it'll be a must to be able to show this. So I think there's been some public sentiment resistance, but for me, it's a safer environment. I've received my vaccine, and therefore I feel very comfortable around other people who've got a vaccine. If you haven't, then there's just higher risk. So I think it's something that makes sense. We have technology that enables it. It's a great use case of our technology to showcase how being able to verify information on a counterparty, whether it's our online or on a vaccine, that's a really useful spot around the identity management space and trust ecosystems. And I think our group does a fabulous job of that.
Okay, good. And then I think in the past you've talked about a visual AI HIPAA compliant public cloud software. Can you just give us a reminder as to where you stand on that? On that product and the interest level?
Our AI group had first, during COVID, you saw even using some of the AI technology for monitoring of manufacturing shop floors, because to work out physical distancing, it's hard for a security guard to look at a camera and go, oh, they're too close. But when you have the software, that at the end of a shift, it would generate a report to say, you need to train these people because here they had 3 violations here of being too close according to our protocols. During this now, it's recognition of people on the AI side to match them to our vaccine passport. So the AI component is really in all of these solutions. And again, because we have so many healthcare customers, we've got a HIPAA compliant data center as well, being able to handle health records. The key part here is transparency, but privacy. So what is the information I need to know? Are you vaccinated? Have you been tested and was it positive or negative? Not of all my personal detail. And that's the wonderful part about this. So Vivo had this as well with in Canada around the Saskatchewan health system and being able to combine the health system in Canada or in the US being HIPAA with this transparency around data. That's a powerful combination.
Okay. And then just talk about new product development that is going on at Converge. I always like to see, if you guys are working on anything that is proprietary, that you are excited about, that you're going to be bringing to the market, whether it's this year or even in the coming years, products that I think offer you the opportunity for further gross margin expansion. So any insight on proprietary product
really
development?
it's the trust platform, right? We're going to be embedding that into all of our managed services because identity management is so key. You see the success that Okta has had in the US. They're just consolidating. We partner with them around this, but what we really specialize in is on verification of counterparties. And in this zero trust world, that the work from anywhere world, you have to be able to validate your counterparties. The old model of trusted applications is broken. You have to be able to exist in a zero trust environment. So I see some explosive growth for our trust platform around that being rolled out into all of our managed services applications. That's a key area of differentiation. We'll continue to look for IP that will differentiate. If there's something already in the marketplace that we don't feel there's a gap, we're happy to use it. But where we feel there's a gap that we can provide some uniqueness around it, which is really needed, and this is a great example, then we will invest in those areas.
Okay. Before we move forward, I will say, just remind everyone that if they do have a question, either raise your hand and we'll get to it, or if you have a question, you want to use the chat, feel free to do so. So obviously, M&A is a very important part of your story. We certainly, saw another recent acquisition out in California. So congrats on that one.
Yeah.
The question that comes up in investors' minds is, just given the fact that North America is a very sizable opportunity, and certainly all the deals you've done thus far have been in North America, and you've said you'll like to do 4 to 6 per year, go at least in the near term. The question that has come up from investors in the past is, why do you feel a need to pursue European M&A at this time, just given the prospects that North America offers?
Because it started with, we were asked to by Google, and Infor wanted us to provide the same solution that we provided in North America in Europe. They don't have a partner providing it there. And the managed services is the prize at the end of the strategy. The fact that we have these partners saying, we really need you to provide this in Europe as well, it was extremely compelling, because that's what, you buy these companies to get their customers, to get them on the managed services. If we can lead with the managed services and they're a channel for us, that's really fantastic. It still works. The other part is, in phase 1, the CEOs reported to me. Then we had these regional presidents. Now Greg's got sales, marketing, and engineering. Corey Reed does the integrations. I help out with acquisitions and do IR. I'm actually looking forward to getting, my hands a little dirty again and some acquisitions and more ground floor here in Europe, because to be frank, I'm not required on the operations side. We're a well-oiled machine. They've got this thing down really pat. And on the operations side, I provide oversight, but I do not provide day-to-day operations in our functions. Greg Berrar, our president, does all the sales, marketing, and engineering. As mentioned, Corey Reed's got all the integrations. So I'm looking forward to, I'm quite excited by the European expansion opportunity. Okay.
So on the European side, just give us a sense of how big is that funnel today, how you're narrowing that funnel to decide which ones you're going to pursue in the short term, what you're willing to pay when it comes to the European market, especially because you want to establish a beachhead.
Yep.
Where you want to invest, and maybe give us some color as to what that initial beachhead has to look like. What does the foundation need to look like so that you could leverage that initial transaction for further tuck-ins within the European market.
Super. So we just mentioned that we've announced Doris Albiez as helping us out in Germany. Doris is a very talented lady who comes from ran Dell's channel before then IBM's channel. She's known these companies for 30 to 35 years and has a trusted relationship. And rather than the fast talking Canadian talking to the Germans, having the German lady talk to the Germans has been much more effective. So we met with 64 companies. We made a short list of 16. We have NDAs with 4 in Germany of companies between 75 and 200 million euro. So this is larger than the typical sweet spot that we have in North America when you convert it to Canadian dollars. And so because you've kind of got 119 is euro to the US dollar. So we're kind of aiming for the mid part of that. And I was surprised because Bekla is in Germany and they've acquired 100 companies. So I thought they would have picked over the German marketplace. But what I found was companies of this size, the kind of 150 euro size, don't want to be bought by Bekla because they favor their top 12. And Cancom lost their CEO a year ago, and so they're really not expanding. So I was amazed at how much opportunity there is for us to enter Germany with our mid-market structure, around the same sectors we're going at in North America. There's some wonderful companies for us to look to acquire there. So again, making progress there. In the UK, it's a market I'm very familiar with. We're going for 75 to 200 million pounds sterling. There. And I've been meeting with all the vendors and they said, Shaun, look, there's some great partners in individual countries. Softcat does a great job of the mid-market in the UK, but only addresses 3% of the market. Cancom and Bekla in Germany, Atia in the Nordics. We're looking for a pan-European partner that we can run campaigns with. And also, as I mentioned, Infor and Google are looking for us to offer the same iSeries hosting that we do in North America. So I'm very optimistic. Until we do our first acquisition, I want to be careful about saying, here's what it looks like because we haven't done any yet. But I would hope to be able to get to 4 to 6 companies a year by next year in Europe, just like we continue to do in North America. And the first ones will be larger. We won't get the same efficiencies from the first ones. So sales, marketing, and engineering will remain in country, back office in Ireland, tech resources out of Eastern Europe. But the synergies will be more from 2 to 10 as opposed to the first one. We're saying we'll pay kind of up to 6 times as opposed to it's kind of up to 5 times in North America. And again, we'll be as effective as we can be, but wanted to give ourselves a little bit more leeway as we especially get the platform companies, which are the first ones. Again, the faster growing a company, the larger the multiple that you pay for them is. But again, lots of targets, massive markets. Germany's the largest market in Europe. UK is the third largest one. And going and meeting with the targets, it is definitely there's opportunities for us to expand there and do at a healthy rate. So we're $1.5 billion run rate now in North America after Dasher. You'd look to add. If you're adding companies in the kind of, call it 150 million euro, that's, over 200 Canadian at a pop. So when we talk about a 2 billion run rate by the end of the year, a few acquisitions in Europe, and you're probably around that kind of rate.
Okay. And just looking at, obviously, within the North American market, you've built a well-oiled machine when it comes to M&A integration.
Yeah.
I like to call it that wash, rinse, repeat cycle. The fact that you can integrate and get that margin lift within a year, I think is fantastic. What practices can you take from what you're doing in North America and eventually port over into European market to kind of get you back to build basically the same machine up there?
So one of the key things that we do differently from anyone else that has been so helpful in integrating our companies is on day one after acquisition, having sales, marketing, and engineering report up to Greg, having all the back office people, finance operations, inside sales, HR, and IT all report up to Corey Reed, our COO. That separation is really important as you look for synergies and centralizing those back office functions. So if I had to say one key element of that is from day one, separating those is absolutely key. The salespeople, are regional. The tech people will be across Europe, tech people in North America, across North America, and marketing is a shared function as well. But the back office, separating that out has been absolutely key in our integrations. So that from a structure side, and that's something I haven't heard other people doing, but is very important when we're looking at integrating our companies.
Okay. And then I know you spoke about paying 6 times, at least for the initial European beachhead transactions. What leverage would you be comfortable with as far as taking the company up to basically, over the next 2 years or so to get not only North American transactions done, but also to build that footprint in Europe?
So we started last year, we were over 4 times levered, right? And now we really strengthened our balance sheet. We're less than 1 time, but realize we generate a lot of cash flow. So the analysts have us over 100 million of EBITDA this year. Probably 70 million of that goes to free cash flow. But also realize I've been buying companies with 30 and 45-day payment terms. And the day after I buy them, Ingram Micro now gives me 75-day payment terms. So when you look at my free cash flow, look at my balance sheet at the end of Q1 and end of Q2. So Q4, we bought Vicom on December 31st. They weren't transformed yet. So kind of you didn't really show it. But when you see the terms and the free cash flow extending term generates on top of the cash from operations, that provides you a lot of cash for acquisitions, in addition to the fact that we've got a very healthy balance sheet. We don't want to go back to the levels that we were before on debt. But again, I think we're probably under levered right now. We're not leveraging our balance sheet enough. I would say 2 to 3 times is where it's a very comfortable zone that I think everyone would be happy with. But again, we generate so much cash flow that will actually come down very quickly just from cash from operations.
Okay. And then I guess last question on the European front, what size of a footprint do you think would you like to build, say 5 years out, maybe even 10 years out? Do you see yourself as a major player in the European market, medium size, or just a smaller, more focused player?
So we're planning at our AGM at the end of May, going through our plan to go from 2 billion to 5 billion. And this is on a mid-market customer base. We're looking to dominate globally as a mid-market player. So I think this strategy, we're already in the upper. It's amazing how few really large ones there are. And therefore, when you actually go and look at we were number 50 on the list last year. We'll probably be in the top 40 in North America. At the end of this year, all of a sudden you're in the top 20. There are very few scale providers. We'll pass Softcat, great company out of the UK, probably this year. Cancom and Bekla, Cancom will probably pass the year after. Bekla, we got a little ways to go. Atia is a little bit larger as well. There are very few scale providers. So I think we're going to be in for some rarefied air and absolutely looking to dominate. We're impatient. We would love to grow. This is a really successful model. Rinse, repeat, do things that are not going to overwhelm us. So 4 to 6 a year in a region, I think, is the right kind of cadence to not overburden our local operations and continue to execute on the sales side. I mean, every quarter we deliver. And so looking to do the same thing in Europe. But I think that going 2 to 5 billion, there's scale after that as well. But I think in the next 3 to 4 years, at the end of this year, getting to 2, then moving 2 to 5 in the next 3 to 4 years, I think that's achievable as well.
Okay. And then you use the word global player, I believe, in that response. So it leads me to my last M&A question. I think at some point you probably would look to go into the Apac region. And from my experience, obviously the VARs or value-add resellers play a strong part in really penetrating the Apac region. So the question is, maybe it's premature to ask, but what would be your plans to tackle the Apac region? Would it be obviously acquiring a VAR, or is it something you can, I don't know, establish an office and then assess the market? So just maybe how do you guys look at Apac today, and what would be maybe the plan of attack?
So Google and Infor asked us to go to Apac as well. The problem we've had is the tariff wars that Trump and China went through made business practices very unsteady there. The reason I waited to go to Europe until now was Brexit was complete. If I was in a stable tariff environment where because when you start slapping 25 and 50% tariffs on goods, that changes things dramatically. So if there was a more stable environment, I would consider doing that, it would be after we do Europe. So as we make more progress in Europe, I certainly wouldn't look to do it this year or next year. But once you get into 23, then I think you that would be, yes, a logical extension.
Okay. And then moving into what I like to call just the general round of questions, maybe just remind us again, obviously the NFL cities is a very important part of your US strategy.
Yes.
Just remind us as to why that is.
So I always say if there's a children's hospital in Atlanta and you're providing a telemedicine solution there, I guarantee you there's a children's hospital in every NFL city. And if you've got a telemedicine solution with Cisco in one, Cisco doesn't want to partner with 25 other small regional firms to do the same solution in every NFL city. They want one national provider. So over in Europe, it'll be the Champions League cities, right? That you can do the exact same solution for. So if you can rinse, repeat the same way we do acquisitions, but on solutions that are more productized around if they have a need, and it's this kind of customer, they'll need it. And the NFL, because that's where the population centers are, have the same needs. So replicating that local service, that local implementation around the same solution in those various cities, that's where you get efficiencies and scales. And that's what our vendors want. This is such a fragmented industry. As I mentioned, 175 companies between 75 and 200 million of revenue, and very few large ones. And it just spans out from there in a $1.2 trillion industry in the US, over 3 trillion worldwide. So the same thing exists in Europe. And again, you've got strong players in one country. The same solutions are required across the region. So do they have a partner that can deal with the various cultural and language issues that are different than North America in this strategy? But do I have the right people on my team, Doris, and we'll add others that can help us in making this happen across Europe as well? So that's really the motivation for doing it, is efficiencies in delivering solutions that are required across a region that are the same ones, rather than our vendor partners were pushing us to be able to go and do this.
So if we use your NFL analogy as far as North America, then I guess we should be following a lot of the European soccer leagues and see where they have.
That's to say Champions League. So UEFA, the Champions League or the Europa League, that's exactly it. Those are the cities. Now, Swansea once made it into the Europa League, and I wouldn't call it the class of an NFL city, but we punched above our weight a little bit as well. So
I think on your last set of results, and we've seen this with a lot of companies where lower travel expense and office expenses because of COVID has certainly benefited the bottom line, you guys being no exception. But you were also able to make good progress or get good leverage with workshops, briefings, technical assessments that you guys probably did more in abundance, it seemed like, especially in Q4, because of the lack of travel. Is that something that you guys are looking to implement more, or that those cost savings will continue to be there, or do you think that once the world opens up again, you'll try to do a hybrid of maybe less travel, but recognizing the importance of face-to-face at the same time?
Face-to-face is important, but I think we've been shocked by certain things like this investor conference today. I'd love to be face-to-face, but we've been able to be so much more effective when you don't have to travel city to city to meet people. So you can do things. I still think there's a very important role for face-to-face though as well. But you look at, I've quoted before, Oracle not renewing any leases worldwide, doing work from anywhere. So I think you'll definitely, vendor conferences. So this industry there's a vendor conference in Vegas every week with one of the vendors holding their show that we used to all kind of conglomerate to. Is that the most efficient way? Our national sales meeting, I was amazed at how effective we were in a remote setting. Now, again, there's going to be a hybrid model. I would say services engagements, we're getting our people on site and the travel and things around that. There'll be positive revenue sides. It's not just a cost thing. There's a revenue side associated with that as well. But I do think there's a new normal that'll happen. There will be more costs in travel and entertainment, absolutely. And there should be. I think there'll be a direct business benefit to some of those. And I do think we'll change behaviors in some of the ways that probably weren't as efficient. I think people wouldn't have tried it if it hadn't been for the pandemic. But having gone through this weird experiment we've gone through for the last year, realize there's probably some different ways that we can do certain functions. Certain functions might not ever come back to the office. Certain business practices will be changed forever. We will do less in-face, like most of the conferences will just be less face-to-face because of the efficiency. I do think there's a role for face-to-face though. So there will be more of a hybrid. So there will be some increased cost, but I don't think it'll go back to the way it was before.
Okay. And then when you look at the company as a whole over the last 12 months, obviously workshops, briefings, and assessments aside, what other lesson do you think that the company may have picked up as a result of the pandemic that allows you to be more efficient going forward?
Well, so I've been in Europe or in Bermuda since the pandemic started, over a year. Our chief operating officer is out of Ireland. Neither of us have been in North America for over a year, and we've had our most successful year. Whereas we were back and forth on a plane every week. So I wouldn't have thought that was possible. I think part of it, and we're used to working as remote teams and things like that, but I think learning of what you can do remote was surprising. Now, I think from a planning, there's definitely a hybrid, but there's a whole bunch of lessons learned that I wouldn't have thought integrating back offices would have been possible remotely either, right? We integrated 12 back offices, all done remotely. So, necessity being the mother of invention, I think we learned a lot about what you can do remote. I think there is definitely, we don't want to have to do that. There's definitely a more, as you call it, a hybrid approach to these things, but it showed you that you don't need to do as much travel for the sake of travel. How do you, and also like the benefits of not having like the downtime. The worst part is you're always accessible now. We've never been more effective and efficient because you're available 24/7. Everybody knows you're not traveling. So I'm amazed at how much we were able to achieve. Like we did some really hard things last year. You look at the cross sell, the integrations, the fundraise, the ABL, the acquisitions. Oh my God, partially because we're always available. Now, no one went on vacation either. So I think there's, a happy medium there somewhere, but it was pretty incredible what we were able to achieve in a remote fashion.
Okay. And then the management team, certainly Pivot is a company that comes up a lot because of your prior employment there, including for many members of your management team. What key lessons did you, as a management team, learn from your time at Pivot that you adopted as part of establishing Converge where it is today, and maybe pieces that you were looking to adopt or maybe use going forward as well that you haven't already, that's in your playbook, but you haven't exercised yet?
Yeah, so a lot of the integration and blocking that behavior we stopped was because of the hard lessons learned at Pivot, where it didn't work properly. They had weeby structures and they were large enterprise customers. The whole reason I started this was the last acquisition I did at Pivot was Teramac 100 million in size. And went, oh my God, small players don't get the benefits from rebates and terms that larger guys do and have mid-market customers that need help getting to the cloud. Pivot had AT&T and Apple as the top customers. They don't need help getting to the cloud. So the whole strategy was meant like, why not do large enterprise? Why do mid-market? And a better way to service people was these regional players that have customers that need help getting to the cloud. Really came from Pivot. Pivot, though, the school of hard knocks is a wonderful teacher. And when you get to do it a second time again, you make sure you don't end up. You see the behavior that you want to snuff out early and make sure you do. The blocking behavior. The CEOs, if they don't do sales, they're not, and be respectful of people. Like we reduced our force by 120 people last year, but we try to help them find them jobs. It's a small industry, right? We treat people really well, but you have to move on from people that are going to be in roles that will be blocking your sales motion or your integration. You have to move past that. And that's my job to make sure that happens. So I think we've done a super job. Our models, our structures are based on a lot of the tough lessons learned, the school of hard knocks from Pivot. Definitely, we wouldn't have been able to do what we did in 3.5 years here if it hadn't been for a lot of the lessons learned from Pivot.
Okay. Just one hopefully easy financial question for you. You guys did a good job of, I guess, renegotiating or reestablishing the new credit facility with a far lower interest flow. And I believe you went from the 8-9% range down to the 2-3% range, if I recall correctly.
Yep.
You also have some what I call non-credit facility loans on your books, and the interest rate there is still at that 8-9%. Is there an opportunity in the next year or two where you're either can pay off those loans, or at the very least renegotiate those loans for more favorable terms?
So we have paid off all of our expensive except for where there are notes around earnout. So if they took a vendor note, so it might be earnout plus a vendor note, those terms can't be there. But everything else, so we went through from our highest interest rate down and started knocking them off. So absolutely, that's been a key priority. And our interest, when you look at our year-on-year interest in Q1 versus Q1 last year, it's going to be staggering, right? And throughout the whole year, just when you're at a 9% down to a 2.5%, it is meaningful. And like you say, there was other pieces of, Gord has done such a wonderful job of structuring our acquisitions so that we were able to do all these acquisitions without requiring equity. So there's all these different, funding mechanisms that were used. We don't need them now because we have this wonderful facility, which we extended to 190 million at 2.5%. So getting rid of the higher ones has been a priority. The only ones I think that are residual would be vendor notes that would be at those higher rates. But we've done a super job of really reducing all the higher interest rates, things that were on our balance sheet and consolidating them with the ABL.
Okay. And we are coming close to an end, so I will ask one more general question. And that's basically, when you look at the CTS story today, or the Converge story today, is there a part of the story that, and you can relate it back to Pivot as well, that you believe maybe is misunderstood or possibly not well understood in the marketplace?
Yes. So we have grown our adjusted EBITDA by 90% every single year. I went from 0 to 16 to 31.7 to 60.5. If you understand what does that mean on a go forward basis, and again, people don't bake in acquisitions, but if I do my acquisitions and I end up with 115 next year, that's 90% earnings growth. And then if I do 90% the year after, I'm over 2, right? My multiple is 10 times this year's earnings. When your earnings are growing at 90% and your multiple is 10, it means every day you get a bunch cheaper. So every quarter we execute those numbers and we keep hitting those. Then you put yourself in the chair of the person that was at my, AGM when I was at 16, and then 31, and then 60, and then 115, and understand when you're sitting in that chair looking forward now at 2 something, and then you go beyond that, the value that we're creating is at such a higher rate than at the multiple, so you get much cheaper. People say, oh, your stock's been on a good run. And there was a whole bunch of companies that weren't based on value, that didn't have earnings and free cash flow, that probably got above themselves. We're certainly not one of those. Our earnings are growing at much faster than our stock rate. Our stock rate is struggling to keep up with our earnings growth. And we'll just continue. For me, stock price is just, indicative, but I think what's poorly understood is what those earnings mean. I think this year, because we have so much intangibles, when people look at EPS, some of those things get washed out, but we've taken so much cost out, reduced our interest rates by so much, the free cash flow also from the payables and terms, you're just going to wash in that stuff this year. I think that'll be very meaningful, but that's probably the most poorly understood part of our story, is the conversion of the cash flow and the fundamentals that we generate, in addition to being the fastest growing IT service provider in North America.
That's a great response, and certainly a great way to end this chat. Shaun, thank you so much for attending today. I know you've got a busy day ahead of you, so I continue to wish you and Converge much success. Thanks for joining us today, and stay safe.
Thanks, Nick. Appreciate the opportunity today.
And just a reminder to everyone that we've got Severia coming up at 10 a.m. Thank you.